For years, a spot Bitcoin ETF was seen as the holy grail, a bridge between crypto's wild frontier and Wall Street's order. It was the promise of merging two worlds: the rebellious spirit of digital currency and the established power of traditional finance. Investors and institutions alike waited, convinced that this would finally legitimize Bitcoin in the eyes of the mainstream. The pitch was simple: an ETF would make Bitcoin accessible, legitimate, and safe for the average investor. No more confusing wallets, no more risky exchanges, just a familiar product on a trusted platform. It was marketed as the easiest way to gain exposure to the world's most talked-about digital asset. Wall Street titans like BlackRock and Fidelity launched ETFs, promising easy exposure without the hassle of wallets or exchanges. Their involvement signaled a new era, where the biggest names in finance would finally embrace crypto, bringing it to millions who had previously watched from the sidelines. Billions poured in, and Bitcoin soared to new heights. The excitement was palpable, with headlines touting record inflows and a new wave of mainstream adoption. The narrative was clear: institutional oversight would tame Bitcoin's volatility and bring stability. With regulated products and professional management, the wild swings of the past would be smoothed out, or so it was believed. But this overlooked what made Bitcoin resilient: its diverse, ideologically driven holders and scattered entry points. The decentralized nature of its community was its greatest strength, creating a network that was hard to control or manipulate. ETFs funneled a massive, homogeneous group of investors through a single channel, creating hidden fragility. Suddenly, the fate of Bitcoin's price was tied to the whims of a few large players and the structure of traditional markets. The dream of stability turned into a nightmare in November 2025, when the very instrument meant to de-risk Bitcoin triggered its most predictable crash. The stampede out of ETFs was swift and brutal, amplifying the very volatility they were supposed to contain. Wall Street imported its own risks: herd behavior, algorithmic trading, and a short-term mindset. The same forces that had caused past financial crises now infected the world of crypto, with devastating results. The ETF was not a bridge, but a Trojan horse, delivering a new kind of financial contagion. What was meant to protect investors instead exposed them to dangers they barely understood. The crash wasn't a failure of Bitcoin, but of the financial architecture built around it. In the end, it was Wall Street's own design that proved most vulnerable, not the technology at the heart of the revolution. The first week of November 2025 marked the ETF-fueled Bitcoin rally's dramatic end. It was a week that would be remembered for its unprecedented volatility and market chaos. Bitcoin hovered above $100,000, but the collapse was swift and brutal. Investors watched in disbelief as the price began to tumble. In days, the price plunged, slicing through support levels and falling well below $100,000. The speed of the decline was shocking. This wasn't organic crypto volatility. It was a systematic unwinding, driven by the very ETFs meant to prevent chaos. The safeguards had failed. Between October 29th and November 3rd, spot Bitcoin ETFs saw $1.34 billion in outflows. A torrent, not a trickle. The market was hemorrhaging money. BlackRock's IBIT alone shed $186.5 million in a single day. The scale of the outflows was staggering. Institutional money, once the market's anchor, was now leading the exodus. The very entities that were supposed to bring stability were now causing instability. The ETF's one-click buying became one-click selling, with no friction to slow the panic. The ease of trading turned into a double-edged sword. Traditional investors, unaccustomed to crypto's wild swings, saw the price falter, and algorithms screamed sell. Panic spread like wildfire. The new market participants amplified the speed of the decline. The market was in free fall. The institutional capital that was supposed to stabilize Bitcoin became its millstone. The weight of their investments dragged the market down. The great unwinding had begun, led by the new kings of the castle. The very forces that had driven the rally were now orchestrating the collapse. The crash was centralized, coordinated, and relentless. It was a stark reminder of the risks inherent in the financial markets. The November 2025 crash exposed a critical flaw: a highly concentrated average entry price. Before ETFs, Bitcoin investors were scattered, with diverse cost bases and motivations. This diversity created natural shock absorbers, buyers at different price levels. ETFs changed everything, funneling billions into Bitcoin over just 18 months. The average ETF holder's cost basis, $89,613, a psychological tripwire for millions. As the price neared this level, panic set in. Suddenly, everyone faced losses at once. The shared cost basis triggered a synchronized sell-off, not a staggered reaction. The ETF structure created a single point of failure, replacing layered support with a cliff edge. Once the price breached that average, fundamentals no longer mattered, only self-preservation. The result? A stampede, as everyone tried to exit at the same time. The market's resilience was replaced by fragility. Spot Bitcoin ETFs didn't just change how people bought Bitcoin, they changed who bought it and why. Traditional crypto investors were self-taught, ideologically motivated, and used to volatility. ETF investors came from Wall Street, conditioned to cut losses quickly and follow the herd. For them, Bitcoin was just another ticker symbol, not a philosophy. Their relationship was transactional, not ideological. Automated trading strategies and stop-loss orders dominated their approach. As Bitcoin flirted with $100,000, a cascade of automated sell orders triggered a chain reaction. The price fell into a vacuum, as algorithms executed pre-programmed instructions. The buy-the-dip crowd was too small and too slow to absorb the selling. The ETF's frictionless nature and loss-averse psychology created the perfect storm for a flash crash. For years, Bitcoin's legendary resilience during market crashes was thanks to its retail base. Those so-called diamond hands who refused to sell, no matter how chaotic things got. These steadfast holders became the backbone of the market, weathering every storm and holding firm when others lost their nerve. Their unwavering commitment blunted the worst of the sell-offs, creating a reliable floor of support when panic swept through the markets. But everything changed with the launch of spot ETFs in 2024, which fundamentally altered the landscape for retail investors. Suddenly, ETFs cannibalized the retail market. Why bother with complicated crypto exchanges when you could buy Bitcoin with a few taps in your regular brokerage account? As a result, retail deposits on traditional crypto exchanges plummeted by over 80% by late 2025, leaving these platforms eerily quiet. Retail investors didn't vanish. They simply transformed into ETF investors, trading their independence for the convenience and safety of Wall Street products and adopting its herd mentality. The rugged individualism of crypto natives faded, replaced by the synchronized, almost robotic behavior of ETF-driven trading. So when the next crash hit, the traditional buy-the-dip support from retail was nowhere to be found, leaving the market exposed. The very people who once stabilized the market had now become part of the problem, swept up in the same panic as everyone else. Institutions led the sell-off, and with no counterforce left to absorb the pressure, the market spiraled downward. The irony is clear. The very institutions that were supposed to bring stability ended up scaring away the market's true stabilizers, leaving a void that no one was prepared to fill. Institutional involvement was supposed to bring calm and rationality to Bitcoin. The reality, when pressure mounted, institutions panicked first. The sell-off wasn't led by retail, it was driven by professional traders and algorithms in the ETF ecosystem. Massive outflows came from large block trades, not small investors. Institutions, governed by risk models, exited at the first sign of volatility. Automated strategies like risk parity triggered mass selling as volatility spiked. Institutions showed less conviction than the retail investors they replaced. Wall Street didn't adapt to Bitcoin. It forced Bitcoin to play by its rules. Bitcoin inherited Wall Street's problems, algorithmic fragility and herd behavior. The new face of fear was a multi-billion-dollar algorithm, not a panicked retail trader. The crash revealed that institutional stability was just another form of systemic risk. By conventional measures, spot Bitcoin ETFs were a runaway success. BlackRock's IBIT became the fastest-growing fund in history, with billions in assets. ETFs brought Bitcoin into millions of mainstream portfolios, driving prices to new highs. But this success created dangerous dependence on ETF inflows. The market became a monoculture, driven by a single narrative: institutional adoption equals price appreciation. When ETF demand slowed and reversed, there was no other support. The same structure that fueled the rally efficiently triggered the crash. The market lost its diversity and resilience, becoming fragile in its success. The ETF's success was its undoing. turning tools of growth into weapons of downfall. When the narrative cracked, the entire structure became unstable. Bitcoin became a victim of its own mainstream appeal. Wall Street's promise was stability. Long-term capital and sophisticated analysis would tame Bitcoin's wild swings. For a while, the illusion held as prices climbed in 2024. The November 2025 crash shattered that mirage. Institutionalization didn't dampen volatility. It amplified it in a new structured way. Institutions acted as momentum traders, not value investors. Their buying supercharged the rally. Their selling triggered catastrophe. The stability narrative was flawed. Bitcoin isn't a blue-chip stock or a bond. Institutions applied old models to a new asset, with disastrous results. The ETF structure centralized risk, making the market more susceptible to panic. The perceived safety of ETFs was just a wrapper. Underneath, it was still volatile Bitcoin. Wall Street's stability was an illusion, and Bitcoin inherited its systemic risks. The Bitcoin ETF saga is a cautionary tale of what happens when a decentralized asset is forced into a centralized mold. Wall Street's embrace made Bitcoin more accessible, but also more fragile. The diverse, chaotic ecosystem that gave Bitcoin resilience was stripped away. Institutions, once seen as stabilizers, proved to be the most skittish. The crash wasn't a failure of Bitcoin's technology, but of the financial product built on top of it. Mainstream adoption concentrated risk and homogenized behavior, creating a single point of failure. Wall Street ignored what made Bitcoin unique, importing its own risks. The lesson: you can't force decentralized assets into centralized systems without consequences. Bitcoin's future may depend on reclaiming its decentralized roots, beyond Wall Street's reach.